In this week's lecture, we're going to continue on our discussion from last week talking about risk and return and set up the capital asset pricing model. One easy assumption that we often make about stock returns is that they're going to follow a normal or a Gaussian distribution. And so this is just going to be the kind of bell curve you guys are probably used to seeing. And the nice thing about normal distributions is that all the information that we need to know is encoded in the mean and the variance. So we just need to know the mean and the variance, and that specifies the entire distribution. And so let's think about having a portfolio just consisting of two stocks. Each one is normally distributed, so each one has a mean and a standard deviation, and then they have some correlation rho 1, 2. And so we're going to pick a parameter lambda. Lambda is going to be the weight on stock 1. So the weight on stock 2 is just going to be 1 minus lambda. So we know that the mean, the expected return, is going to be a linear operator. So the mean portfolio return is going to be lambda times the mean return to stock 1 plus 1 minus lambda times the return to stock 2. As far as the standard deviation though, well, we know that the variance is a quadratic operator, so the portfolio variance is going to be given by this expression, lambda squared sigma 1 squared plus 1 minus lambda squared sigma 2 squared plus 2 lambda 1 minus lambda times the correlation times sigma 1 sigma 2. So if we want to find the standard deviation of the portfolio, we just take the square root of both sides. So what we showed last time was that the portfolio standard deviation was only going to be linear if the correlation was equal to 1. So only if the two stocks are perfectly correlated are you going to have the portfolio standard deviation be a linear combination of the individual stock standard deviations. So what does this mean? Well, let's think about plotting the range of portfolios that we can make using stock 1 and stock 2. So we have the standard deviation on the x-axis, and we put the mean on the y-axis. So generally speaking, we think about people, well, people are risk averse and they want high returns. So we want to be moving this way more or less. So let's say we have one stock here, here's stock 1, and then we have another stock here. So stock 1 has a higher mean and higher standard deviation. And if it were the case that the standard deviation was a linear function, then the range of portfolios we could make would just be the straight line connecting 1 and 2, right? Because we know that the mean is going to be linear. If the standard deviation is also linear, then basically any combination between stock 1 and stock 2 is just going to be on this line connecting these two portfolios. So what does that mean? That means if you have two stocks that are perfectly positively correlated, there's no benefit to diversification. If rho actually was -1, we would have a picture that looked like this. So if two stocks are perfectly negatively correlated, we can get the maximum benefit from diversification. Why? Because when one stock goes up, the other one goes down, which means that there is going to be a portfolio. If we pick our portfolio weight just right, we can actually eliminate all of the risk in the portfolio. So that's if rho is equal to -1. So we have rho is equal to +1 here, rho is equal to -1 here. So what kind of picture are we going to get in general? In general, we're going to get this curve. We're going to get this portfolio curve connecting stock 1 and stock 2. So we're going to get some benefit to diversification, right? We're going to reduce the risk in the portfolio, but not eliminate it completely. So we have this portfolio curve here, and the question we might want to ask now is, well, if these are the options that we have, where on this curve do we want to live? What portfolio do we want to choose? Well, in order to do that, we have to define an objective function. What's our goal? One possible goal you might have would be to minimize variance. You want to find the minimum variance portfolio. So in order to do that, the portfolio standard deviation is going to be given by this whole expression. And so what I can do is I can minimize this with respect to lambda. I want to choose the portfolio that gives me the minimum variance. On the picture, it's going to look like this. And so if I take the derivative, it's going to look more complicated than it really is. Basically, I have this whole thing to the 1/2. So I have a 1/2. I bring this thing into the denominator. So I have d sigma d lambda, this whole thing in the denominator. And then we're going to take the derivative of this numerator with respect to lambda. So we're going to get 2 lambda sigma 1 squared plus 2 times 1 minus lambda, and there's a minus sign here, so it's minus 2 times 1 minus lambda sigma 2 squared. And then this one will give me 1 minus 2 lambda times the covariance. So I set this whole thing equal to 0, and I find that the condition for the minimum variance portfolio is to set the portfolio weight equal to lambda equals sigma 2 squared minus the covariance divided by sigma 1 squared plus sigma 2 squared minus the covariance. So that's going to give me the portfolio that gets me as far to the left as possible on the portfolio curve. It's the minimum variance portfolio that I can find on the portfolio curve. By the way, in the special case that rho is equal to -1, I'm actually able to completely eliminate risk. I'm actually able to get a 0 variance portfolio if I pick lambda is equal to sigma 2 over sigma 1 plus sigma 2. So this might be one objective that we want for our investments, right? We might want to find the portfolio that has the least variance, and then this is how we would do that. So like we just talked about, one possible objective you might have for investing is to minimize risk, right? Minimize the variance of your returns. But this is not really what people are trying to do, right? Because if all you cared about was minimizing risk, you would just look for the most safe asset you could find. You would be investing in treasury bills. You wouldn't be investing in stocks, right? So what we're really trying to do is we're trying to find some type of balance between risk and return. We want to take on some risk because if we eliminate as much risk as we can, we're also going to knock our return down. So we want to find some kind of optimal balance between risk and return. The problem with this is something that is subjective, because if you think about it, the balance between risk and return depends on my personal preferences, how much risk I'm willing to tolerate. And depending on what my preferences are like, the math can get very complicated. So let's assume for now that people are risk averse, but we're not going to say how risk averse they are. We're not going to say how their attitudes toward risk actually are. We're just going to say that generally speaking, if we have a portfolio curve where we have the standard deviation here and the mean here, that they would want to move this way, right? They would want more return and less risk. The exact trade-off we're not going to define yet. Now what we're going to do is we're going to build a model from just this. That's going to lead us into the CAPM, the capital asset pricing model. So what we showed last time was that if you have two stocks, you can construct this curve that consists of all the different portfolios that you can make. Well, we have more than two stocks that we can play with, right? Let's throw in a third stock. Let's imagine we had a stock that was here, stock 3. And so, well, if I think about the portfolios between stock 1 and stock 3, I would get a portfolio curve that looked like that. And then if I thought about the portfolios between stock 2 and stock 3, I would get a portfolio curve that looked like that. But of course, there's more to it than that even, right? Because, well, now I have 3 stocks. I don't need to just consider pairs. I can consider portfolios that include all 3 stocks. And I can think about throwing in a 4th one, or a 5th one, or a 6th one. So I want to think about, well, what are all the portfolios that we can construct using all the stocks we have available? Now, with 2 stocks, the portfolio curve makes sense because we have a 2-dimensional diagram and 2 stocks. Well, no matter how many stocks we add, it's still going to be a 2-dimensional graph. So what you can see in this picture is that there's some portfolios that we definitely don't want to invest in, right? Because if we're just saying that people are risk averse, so that I want higher mean and lower standard deviation, if I compare this portfolio with, say, this one, well, this one has a higher mean and a lower standard deviation, which means that if this is an option, I would never want to choose this one, right? So I don't have to think about all of the portfolios I can construct using the stocks in the market. I just have to think about sort of the outer envelope of the ones that are not unambiguously bad, right? That I want to ignore all the portfolios where I could improve on both the mean and the standard deviation. So I'm going to kind of construct this outer envelope that consists only of the mean variance combinations of the portfolios that I'm not eliminating right off the bat. So I'm going to construct what's called the efficient frontier. There are portfolios I can make with stock 1, 2, 3, 4, 5, and 6. But I don't want to consider anything in here because anything inside here I could strictly improve upon. So what I want to think about is the line of portfolios that I can't improve upon. So what does it mean I can't improve upon it? I said that I want a higher mean and a lower standard deviation. However, I did not specify the exact trade-off yet between return and risk. All I'm saying is I don't want to invest in anything where I could improve upon it and get both a higher mean and a lower standard deviation. So I'm going to define what's called the efficient frontier. The efficient frontier is going to be the outer envelope of all of the portfolios I can choose, and I'm going to define the condition as saying, okay, I'm going to fix some level of risk that I'm willing to accept. And I'm going to say, of all the portfolios that I can choose, what's the highest return that I can get? I'm not saying that this is necessarily the amount of risk that I want, but for any level of risk that I could choose, I'm going to pick the highest level of return achievable. And when I sketch out that line, that's going to give me the efficient frontier. The efficient frontier, therefore, is just going to be the top half of this curve. The bottom half doesn't count, right? Because if I'm picking, say, this level of risk, I'm not going to want to be down here. I'm going to want to be up here. So remember, all I assume so far is that I like high returns and I want lower risk. Just by imposing that condition, I've eliminated from consideration any portfolio that's not on the efficient frontier, right? Any portfolio that doesn't maximize my return for a given level of risk, well, I wouldn't want to invest in that, right? Because either I'm taking less of a return than I could otherwise get, or I'm taking on more risk than I otherwise would have to. And I don't want to do either of those. Solving for the efficient frontier is an example of something that we do a lot in economics, which is constrained optimization problems. So we can define the portfolio mean as being, I'm not going to write the subscript here just to save space. The portfolio mean is going to be linear. We showed last time the portfolio standard deviation, the portfolio variance is the double sum. And I also have this condition that all of these have to add up to 1. All these portfolio weights have to add up to 1. So I have these three things. And what I want to do is I want to define my optimization problem. What I want to do is I want to maximize the portfolio mean subject to the condition that the portfolio variance equals some fixed number. So I'm fixing the amount of risk I'm willing to take on and maximizing the return I can get. And I also have another condition, which is that all the portfolio weights have to add up to 1. So I'm maximizing mu subject to sigma is equal to sigma hat, and the additional condition that all the lambdas add up to 1. So if you're familiar with constrained optimization problems, you'll know that the way to solve a problem like this is to convert the constrained optimization problem into an unconstrained problem. And you do that by constructing the Lagrangian. The Lagrangian is going to be equal to the objective function, which is mu. Let's write that out as a sum. Plus, we're going to have this kappa, and this is going to be called a Lagrange multiplier. The Lagrange multiplier is going to reflect this constraint. So what's the constraint? Well, the portfolio variance has to equal the sigma squared hat. That's a constant reflecting how much risk we're willing to take on. And so you can think about putting this term in the Lagrangian as penalizing you if you go over the prescribed level of risk. And you also have another constraint here, which is that all the portfolio weights have to add up to 1. So we're going to throw in another Lagrange multiplier that reflects this constraint. So now what we're going to do is we're going to maximize lambda with respect to our choice variable. Sorry, we're going to maximize L with respect to our choice variables, which are these lambdas, as well as the Lagrange multipliers. So if we were to do that, what would we get? Well, dl d kappa 1 is going to just equal this constraint. So if we're optimizing with respect to the Lagrange multipliers, we're going to ensure that whatever solution we have is going to respect the constraints. So the constraints will indeed be satisfied at the optimum. And we're going to have dl d lambda I is equal to 0 for each of these portfolio weights. That expression is a little bit more complicated. We're not going to deal with that right now. So the actual process of going through and solving that constrained optimization problem, there's a lot of tedious algebra involved. We're not going to go through that whole thing. But at the end of it, what you're going to get is you're going to get this efficient frontier. You're going to get portfolio weights such that for any level of risk you're willing to tolerate, you're going to pick the portfolio that maximizes the return given that amount of risk. Now, we still haven't answered the question, though, of where exactly on this efficient frontier you want to live, right? All of these portfolios are efficient in the sense that there's nothing that's better both in terms of return and in terms of risk. So where on the efficient frontier do we want to invest? Well, in order to do that, we need to introduce a risk-free asset. So let's imagine that there is some risk-free security, like a treasury bill, that allows us to get a guaranteed return with no risk. This is going to change our calculation a little bit. Why? Well, because if I pick any stock portfolio, let's say I pick this one, so I have a risk-free asset and a stock portfolio. Well, that means that I can take a combination of the risk-free asset and the stock portfolio. So I have a portfolio that consists both of stocks, so all the stocks that are in this portfolio, in addition to the risk-free asset. And so now I'm going to consider drawing a portfolio curve between here and here. Well, drawing a portfolio curve involving the risk-free asset is pretty easy because, well, the risk-free asset has no risk, so there's no diversification possible. It's just going to be a straight line between RF and P. But think about what's going on here. If I can invest in a risk-free asset, I'm going to draw a line that's going to cover up some parts of the efficient frontier. These portfolios still can't be improved upon, but these can. I wouldn't want to invest anywhere here now, because if I take a combination, I would never want to invest in, say, P prime, because there is a combination of P with the risk-free asset that gives me a higher return and lower risk than P prime. So I wouldn't want to invest in P prime anymore. And P prime is on the efficient frontier. So by introducing the risk-free asset, there are now portfolios that were on the efficient frontier that I have now ruled out also. But this isn't the only line I can draw. I can draw another line from, let's say, call this one P double prime. I can draw another line from RF that covers up that one. And so now I want to rule out all of these portfolios and all of these ones. So hopefully you can see what's going on here. By introducing the risk-free asset, I'm now able to construct portfolios that, in addition to being better than portfolios in the interior, are also better than portfolios that used to be on the efficient frontier. So I said that if I take any portfolio, any stock portfolio, I can draw a line between RF and P that's going to represent all the different combinations of this stock with the risk-free asset. By the way, if I go up here, that means I'm actually putting a negative weight on the risk-free asset, which means that in order to get up here, I need to borrow at the risk-free rate. So I'm putting a negative weight on RF, and I'm investing more than my starting wealth in stock P. But within the confines of the CAPM, we're allowed to do that. We're allowed to borrow and lend at the risk-free rate. So I can think about drawing similar lines between RF and any stock portfolio. So what you can see here is that the steeper that line is, the more stock portfolios that it's going to dominate in the sense of having higher return and lower risk. So this tells us what we need to look for. We need to look for the line connecting the risk-free rate with a stock portfolio that's the highest one, the highest slope. And what's that going to look like? We're going to end up drawing the line between RF and the efficient frontier that lies exactly tangent to it. And you can see what's going on here. Let's call this the tangency portfolio. This tangent line lies above the entirety of the efficient frontier. What does that mean? Well, not only does it lie above the efficient frontier, it lies above every other portfolio. So if I had the ability to borrow and lend at the risk-free rate, the only portfolio I would ever want to choose is some combination of the tangency portfolio and the risk-free rate. Anything else can be strictly improved upon just by going to something on this line. I would never want to choose a different stock portfolio. The only stock portfolio I would ever want to choose is T, and if I combine that with the risk-free rate, I can get a portfolio that's better than any other portfolio I could conceivably make. So if we look at this picture, what defines the tangent line? Well, what defines a tangent line is that it's the highest line that connects the risk-free rate with the efficient frontier. The highest in the sense of having the greatest slope. So what's the slope? Well, the slope is the rise over the run. The rise is the portfolio mean minus the risk-free rate. The run is the portfolio standard deviation. So for any portfolio that I could pick, this is going to describe the slope of the line that connects this portfolio with the risk-free rate. What defines the tangent line is it's the portfolio that has the highest such ratio. And this is called the Sharpe ratio. So you can think about the Sharpe ratio very much encapsulates what we're trying to do. The numerator is the excess return. So it's the excess return over the risk-free rate. We want that to be as high as we can get it. The denominator is the volatility. We want that to be low. So it makes sense, therefore, that we would be looking for the portfolio with the highest Sharpe ratio. It's going to give us exactly the best ratio of return to risk. So what we talked about before was that in order to get on this line, we need to be able to borrow and lend at the risk-free rate. So the line connecting RF and T, this is lending, right? Because this means putting a positive weight on the risk-free asset. Whereas up here, this represents borrowing because it's putting a negative weight on the risk-free asset, and as a result, we're putting more than our initial wealth into this tangency portfolio. So it's a little bit more plausible that we're able to lend at the risk-free rate. Borrowing at the risk-free rate, that seems a little bit more out there, but for the sake of the CAPM model, we're going to keep that assumption for now. So in order to set up the CAPM, we need to list all the assumptions that we're going to make. So the first one we're going to make is that everybody is risk averse. Now, like we said at the beginning, we're not going to specify how risk averse they are, just that they like higher returns and lower risk. We're going to say that everybody is competitive. This means that everybody's a price taker. You don't have any ability to manipulate the market price of any asset. We're going to say that everybody has the same information and beliefs. So this means that there's no private information. Everybody has access to the same information. We're going to assume that you can borrow and lend at the risk-free rate. This, we already talked about, is one of the stronger assumptions because we know that most people can't borrow at the risk-free rate. We're going to say there's no taxes or transactions costs. What this means is there's basically no market frictions that make it difficult or troublesome to rebalance your portfolio. And we're going to assume that assets are perfectly divisible and you can short sell. What this means is that you can basically choose your portfolio weights to be whatever you want. There's no kind of jumps that are required because you need to own whole shares. Now, this is a very strong set of assumptions. Basically, these assumptions describe what we think of as like an ideal market, a market that has no frictions, no private information. Everybody behaves in a perfectly competitive manner. And while we do not necessarily believe that these assumptions will actually hold in reality, the point of the CAPM is not necessarily to be a perfectly accurate asset pricing model. It's more of just a way to get some intuition and be a jumping off point that allows us to understand other models that don't have as strong of assumptions. So you think about it, don't think about CAPM necessarily as being a model that's intended to be as accurate as possible, because with these assumptions that are this strict, it's unlikely that they'll be fulfilled in practice, which means it's unlikely that the market returns are going to line up with what CAPM predicts. Okay, so what happens if we make these assumptions? Well, we've been looking at pictures that kind of look like this. We have our efficient frontier, we have our risk-free rate. Well, everybody has the same information and beliefs. Everybody has the same investment opportunities, which means that everybody has the same efficient frontier, the same risk-free rate. And if everybody has the same risk-free rate and efficient frontier, that means everybody has the same tangency portfolio. Now, what was the result of that? If you're able to borrow and lend at the risk-free rate, you would only ever invest in portfolios on this line. You would only ever invest in combinations of the tangency portfolio and the risk-free rate. So what does that mean? That means that if we look at every investor's stock portfolio, every investor holds the same combination of stocks. Not everybody has the same level of risk tolerance, but you can adjust how much risk you're willing to take on by either borrowing or lending at the risk-free rate. You would not be choosing a different stock portfolio because you could think of an alternative stock portfolio as maybe having less risk, but you wouldn't want to choose it because if you wanted less risk, you just mix in some of the risk-free asset. So if the CAPM assumptions hold, every investor has the same combination of stocks. And if every investor has the same combination of stocks, then the portfolio weights of the tangency portfolio, every investor has the same portfolio, so the weights should be the same as the weights of the market as a whole. So the tangency portfolio is really the market portfolio. So let's carry forward an idea that we started talking about last time, which is that if we're thinking about the return to a particular asset, if we think about any given stock, the return is related to how risky the stock is. However, what matters is not how risky the stock is overall, because that risk contains both market risk and specific risk. And the specific risk can be diversified away, which means that it should not be priced in. So what does that mean? The return to a stock is related to its risk, but not to its overall risk. Rather, what matters is how much risk it contributes to a well-diversified portfolio. So let's pick some stock in here. Let's call this stock I. And then we want to think about, okay, well, if I mix stock I with a well-diversified portfolio, and what's a well-diversified portfolio? Well, this one, the tangency portfolio, the market portfolio. And I'm going to think about, well, what's it going to look like if I draw a portfolio curve between I and M? If I draw the portfolio curve between stock I and the market portfolio, what's it going to look like? Well, is it possible that this portfolio curve is going to cross the tangent line? Well, no, it can't cross the tangent line, because that means that I could make a portfolio that's higher than the tangent line. And the tangent line has to be above any stock portfolio I can pick. So it's not possible that the portfolio curve between I and M actually crosses the tangent line. So it can't cross this way, it also can't cross this way, because if it crosses either way, then there's going to be some portfolio I can make that's a strict improvement over the tangency portfolio, which I don't want to allow. So, well, if it can't cross the tangent line, but we know it's got to intersect the tangent line because the portfolio curve has to intersect M, and M is on the tangent line, which means that if I draw a portfolio curve between I and M, that's also got to be tangent to the tangent line. So what does that mean? Well, what's the slope of the portfolio curve? It's going to be d mu p d sigma p. Right? It's going to be how much the mean return changes over how much the volatility changes. Now, what are we doing with the portfolio curve? Well, we're picking weights and we're kind of parameterizing this graph. So if we let theta be the weight that we put on the market portfolio, we can say the slope is actually d mu d theta d sigma d theta. And the slope of this portfolio curve between stock I and the market has to equal the slope of the tangent line, because if two curves are tangent, they have to have the same slope. So this has to equal the market Sharpe ratio, which is the market return minus the risk-free rate divided by the volatility of the market return. If we're plotting the portfolio curve, where I put a weight of theta on the market and 1 minus theta on stock I, these are going to be the mean and standard deviations. So what I want to find now, I want to find d mu d theta. That's fairly simple. That's just going to be the return to the market minus the mean return to stock I. And d sigma d theta, well, that's going to be a little bit more complicated. Right? I got to do this whole thing to the 1/2, so I have. And then up here, I'm once again going to find the derivative of the expression inside the square root, which is going to be 2 theta sigma squared m minus 2 times 1 minus theta sigma squared I plus 1 minus 2 theta sigma squared im. And so what I said was that d mu d sigma evaluated at theta is equal to 1, right? Because it's tangent to the tangent line when it intersects the market portfolio, which is theta is equal to 1. So I want to evaluate this whole expression at theta equals 1. At theta is equal to 1, this whole denominator is just sigma m. The numerator is going to be sigma squared m. This one goes to 0 minus sigma squared im. So this whole thing equals mu m minus mu I divided by sigma squared m minus sigma squared im, the covariance, divided by sigma m. And all this, we said, was equal to the Sharpe ratio. And the Sharpe ratio is mu m minus rf over sigma m. So we have this expression. We derive this expression from the fact that if I draw a portfolio curve between the market and any arbitrary stock, that portfolio curve has to be tangent to the tangent line. If I rearrange this guy, what do I get? I multiply this by this. I'm going to get mu m minus mu I is going to equal sigma squared m minus the covariance over sigma squared m times mu m minus rf. I can write this thing as 1 minus sigma squared m sigma squared im. So if you rearrange this some more, the mu m, if I rearrange this thing some more, I'm going to get mu m minus rf minus sigma squared m sigma squared im times mu m minus rf is equal to mu m minus mu I. I'm going to cancel this out with this. I'm going to move this, well, I'm going to move this over here. I'm going to move this whole term over to the left-hand side. And what am I going to get? I'm going to get that mu I minus rf is equal to sigma squared im divided by sigma squared m times mu m minus rf. Okay, so this equation is actually telling us a lot. Here, we have the risk premium to the market portfolio, right? This is the excess return that the market portfolio can earn over the risk-free rate. On the left-hand side, we have the excess return to the stock I. So this is the return to stock I minus the risk-free rate. And here, well, where have we seen this before? This is the covariance between stock I and the market portfolio divided by the variance of the market portfolio. What's this thing? This, if you recall, was beta. Beta is a measure of how much exposure stock I has to market risk. So what it's saying is that the risk premium that stock I is going to pay is going to be proportional to how much exposure it has to market risk. the higher the exposure to market risk, the higher the excess return that stock I pays. If I rearrange this, I can write the CAPM in its more familiar form, which is that the expected return to stock I is equal to the risk-free rate plus beta times the expected return to the market minus the risk-free rate. So essentially, the return to stock I is entirely determined by how sensitive it is to market risk. Now, if you remember, when we were doing this, we had beta, but we also had alpha. Well, there's no alpha here, right? So what happened to alpha? What this equation is saying is that the only return that stock I is able to offer is as a result of its sensitivity to market risk. If you think about what alpha I represented the excess return that stock I could pay over and above what its level of exposure to market risk would indicate. And what we're saying with the CAPM equation is that there's no alpha. There's no additional return that you can earn beyond compensation for market risk. So what is the CAPM saying? The CAPM is saying that if I were to plot the mean return to a portfolio against beta, I'm just going to get a straight line. And the slope of this line is just going to be equal to the market excess return. What it's saying is that every stock only has a return which is proportional to its level of exposure to market risk. I can't have a stock that lies above this line. This line is called the security market line, because a stock that lied above this line would have a positive alpha. It would have an excess return that can't be explained by exposure to market risk, and in the context of the CAPM, we can't have that. We also cannot have a stock that's below the security market line. This would have a negative alpha. So if we plot beta against the mean return, we get the security market line. So what we see here is that we have stocks that are below the security market line, and that's not allowed in CAPM either, because we're not allowed to have positive alpha, but we're also not allowed to have negative alpha, because this means we could get excess returns by shorting these stocks. So how well does the CAPM actually hold up in practice? Well, of course, not very well, right? Because the CAPM says that everybody has the same portfolio, and while index funds are getting more popular these days, I think we're far from the point where everybody is just buying and holding the market. So people have different stock portfolios. The idea that everybody just has some combination of the risk-free asset and the tendency portfolio is not true. And in practice, what we see is that there are stocks that have positive alpha and stocks that have negative alpha. Now, anytime we have an economic model and we see that the results are not matching reality, we have to look at the assumptions. And of course, we said from the beginning that the assumptions of the CAPM were very strict. And in practice, pretty much all of them are violated in some way, right? Because, well, there are taxes and there are transaction costs, and you can't always short sell, and you can't always borrow and lend at the risk-free rate. And some people do have inside information. Not everybody necessarily behaves as a price taker. Okay, so we said that the CAPM didn't necessarily fit in practice, that we were going to find stocks that were above the security market line with positive alpha and stocks that were below the security market line with negative alpha. Now, what you can see in this graph is that, well, the positive and negative alpha stocks, well, if they were just randomly distributed, then that would be one thing. But we can see that there's some kind of a systematic pattern here, right? Where the low beta stocks tend to have positive alpha and the high beta stocks tend to have negative alpha. So what this is showing is that stocks with positive and negative alpha don't seem to exist just because of noise, right? Just because of the randomness in the data. There is some kind of systematic effect going on. In some sense, there is something that is being priced in beyond market risk. So we talked about from last time that there were specific risks and market risks. There were risks that affected individual companies, and there were risks that affected the market as a whole. But, well, there's a considerable amount of space between these two, right? We can think about risks that don't necessarily affect the entire market, but affect some class of stocks, some broad array of assets, but not the entire market. So it's not market risk, but it's some type of systematic risk, right? It's more than something specific to a company, but it's distinct from something that affects the entire market. So the question is, are these other systematic risks beyond market risk also priced in somehow? So we can think about a more general version of the CAPM, which is the arbitrage pricing theory. So in the CAPM, the excess return to a stock was just dependent on the market risk. So we can say that there is some risk factor that stock I has exposure to. So in the CAPM, the one and only risk factor that matters is market risk. We can generalize this by saying, well, rather than having a single factor, we can have multiple factors. So we can have up to, let's say, k factors that influence asset returns. We can throw this alpha in front of there. And each of these risk factors is going to be priced in. So we can pick any risk factors that we think will be relevant, and we'll go through some examples a little bit later on. And what we're going to do is we're going to find betas for each stock and each risk factor by doing a time series regression. So we're going to define the risk factors that we think are relevant and find the sensitivity of each stock to each risk factor. And then what we're going to do is now we're going to use the betas as the regressors and we're going to regress the mean return on these betas to find these risk premium. So we're going to define factors that we think are relevant, find the sensitivity of each stock to each factor, and then for each factor, we're going to find how much additional return a stock gains as a result of sensitivity to this factor. Now, in the CAPM, it's a little bit confusing because the market return was both the risk factor as well as the risk premium. But that's not going to be true in general. So under the arbitrage pricing theory, we're going to once again get that the excess return is going to equal some beta times a risk premium. So in the CAPM, the beta was the market beta, the risk premium was the market return. But instead of restricting ourselves to just having one relevant risk factor, we're going to have as many risk factors as we want to include. So each risk factor, some type of risk that we think is relevant to stock returns, has a sensitivity and a risk premium, and the excess return to any particular stock is going to be completely explained by the sensitivity to each of the risk factors in our model. So according to the arbitrage pricing theory, the excess return to stock I is the sum of all of these terms. Each term represents the compensation for exposure to each of the risk factors plus this error term. Now, if you run the regression, we're going to get stocks with positive error terms. That means they're going to have positive returns beyond what the model can explain, and we're going to get stocks with negative error terms. Now, because it's called the arbitrage pricing theory, what that means is that we should be able to construct some kind of arbitrage portfolio. And what are we going to do? Well, we're going to do the thing that seems natural. We're going to buy the stocks that have positive excess returns, so positive epsilons, and we're going to sell the stocks that have negative epsilons. And in fact, we're just going to set our portfolio weights to be epsilon. So epsilon I, the error term in the cross-sectional regression, is also going to be the weight that we're going to use for our arbitrage portfolio. Now we know that one of the conditions for the regression is that all the errors sum to 0. The fact that all the errors sum to 0, remember the errors are our portfolio weights here, means that we have no initial investment required. And all of the error terms are going to be orthogonal to each of the betas, because the betas are the regressors in this regression. What this means, of course, is that if we have this arbitrage portfolio, the arbitrage portfolio is going to have 0 betas. So we're going to have a portfolio that doesn't require any initial investment, and it has 0 exposure to any of the risk factors. Well, what kind of return is our arbitrage portfolio going to have? S is our arbitrage portfolio. Our weights are these epsilons, the error terms, and mu I, well, that's going to be the mean return to stock I, and that is given by gamma naught plus sum of gamma I beta I k plus epsilon I, right? This is the return to stock I. And if we think about each of these terms, well, the errors all sum to 0, so this term is equal to 0. And then we have the sum of each of these. Well, this is equal to the portfolio beta, but because we chose the portfolio weights to equal these errors, our portfolio has 0 beta for each of the risk factors, so these terms all go to 0. So finally, all we're left with is this last term that's just the sum of squared errors. Well, this term is always going to be positive. So if these two terms are negative, this term is positive. That means this arbitrage portfolio, which, like we just said, arbitrage portfolio has weights that sum up to 0, so it requires no initial investment. It's not exposed to any of the risk factors, and yet it guarantees a positive return. So if there were stocks that had positive excess return and stocks that had negative excess return, then we could construct this arbitrage portfolio and get a guaranteed payoff without being exposed to any of the risk factors. So this is the argument, therefore, that all the stocks need to have returns that are described by the arbitrage pricing equation. Now, let's complete the argument. With any type of arbitrage-based argument, what we're saying is we have a bunch of things that are available that are not priced according to some pricing model that we want to prove. So the arbitrage argument goes, I want to buy the undervalued and sell the overvalued. I get some type of free return from this. And to complete the argument, any type of arbitrage argument, if I buy the undervalued, that'll cause the price of that to go up. If I'm selling the overvalued, that's going to cause the price of those things to come down. Which means, as a result of people exploiting the arbitrage opportunities, the prices will naturally converge to what is indicated by the model. So as a result of investors exploiting any available arbitrage opportunities, the returns to each stock are going to converge to the level that's prescribed by the arbitrage pricing theory. So we've been talking about the arbitrage pricing theory, about these different risk factors that could be priced in, but we haven't really talked about what these risk factors are. So we have this idea that there's these broad classes of systematic risks that affect groups of stocks, if not the entire market. So what kind of risk factors are we talking about? Well, this is always something that we need to identify by looking at patterns in the data. We look at patterns in the data and see, is there something here that needs explaining? And so we're going to look at one of the more famous examples of a multi-factor model, which is the Fama and French three-factor model. So one factor we already know. Market return is a factor. And Fama and French additionally looked at stock returns and they saw two things. That small stocks, so stocks with smaller market caps, have higher returns than big stocks. And value stocks have higher returns than growth stocks. So value stocks were defined as stocks with high book-to-market ratios, and growth stocks were defined as those with low book-to-market ratios. So this was just a pattern that Fama and French noticed in the data, that there was some excess return you got for investing in small cap stocks, that smaller companies granted some type of additional return to investors. And this was one thing that they wanted to investigate. This is one thing they wanted to include as a risk factor. Another thing they wanted to include as a risk factor was that value stocks, basically stocks where they had a lot of assets on the books compared to what they were worth on the open market, were going to offer an excess return over growth stocks. So this is the sort of table that Fama and French were looking at. So basically what we do here is we divide the market into quintiles based on size and book-to-market ratio. And what you can see is that indeed, if I look at the table, the returns tend to get bigger as I go from the bottom to the top. So small stocks have a premium over big stocks. And as I go from left to right. It's not exact, but that's the general trend. So high book-to-market value stocks are going to have excess returns over the low book-to-market growth stocks. And sometimes showing a table is actually just as good of evidence as having some type of rigorous analysis. We see here in the table that there's a pattern. That gives us enough reason to be wanting to investigate it. The important thing to remember here is that we're identifying risk factors. However, each risk factor should be some type of portfolio that I can invest in. So what I don't want to do is just say, okay, well, I'm going to have the market beta here, but I'm also going to imagine there's some risk premium based on market cap, and there's another risk premium for book to market ratio. I don't want to include these in the regression directly. So what does that mean? When I'm talking about the small versus big as a risk factor, what I mean is not that there is some inherent compensation for being small. What I'm saying instead is that small stocks face certain types of risks that big stocks don't have to deal with. At least that's what I'm conjecturing. And that whatever these risks are represents something that investors want compensation for. Same way I'm saying stocks with high book to market ratio. Well, think about what a value stock represents. This is a company that's worth a lot on paper, but investors just don't believe that the company is worth that much. So a stock with high book to market ratio is somehow flawed in a way, right? There's something that investors don't like about it. So it's not so much that having a high book to market ratio is inherently something bad that people want compensation for. It's that these types of companies tend to share certain types of characteristics, and that any company that has exposure to this type of risk, whether they be high book to market or not, will have to pay some additional return to compensate for that. So what did Fama and French do? Well, they constructed 6 portfolios. So what they did was they split the market into small and big stocks. And then for book to market ratio, they split it into low, medium, and high. So this is a 50-50 split. And in this axis, it was a 30-40-30 split. And they're going to define each risk factor as a portfolio. So the market risk factor, well, we already know what that is. That's the excess return to the market. To measure the excess return to small stocks, we're going to take the excess returns for the stocks in the top row over the stocks in the bottom row. And finally, to measure the excess return of value stocks over growth stocks, we're going to take the excess return of these high book to market ratio. So the right column over the returns, the low book to market ratio, the ones in the left column. So what you can see here then is that each risk factor is going to represent a portfolio that you can actually invest in. The market risk factor is just the market return over the risk-free rate. You get that by investing in the market. The SMB risk factor, that's the excess return of small stocks over big stocks. Well, that represents a portfolio where you buy the small stocks and you sell the big ones. And the HML risk factor, well, that represents a portfolio where you're buying the high book to market, the value stocks, and you're selling the low book to market, the growth stocks. And so you're going to run this procedure in 2 stages. First, you're going to get these factor returns, and you're going to get the returns to each stock, and you're going to get 3 betas for each stock. You're going to get the market beta, the SMB beta, and the HML beta. And then once you have each stock's beta, you're going to run the cross-sectional regression and get these risk premia that represent how much compensation each stock is going to get for exposure to each of these risk factors. So here we have a table showing the results of running this 3-factor model on a bunch of different sectors. So for each sector, we have the market beta, which we already know what that is. We have the small minus big beta, and we have the high minus low beta. So just because a particular company or a particular sector may have a high, SMB beta, this doesn't necessarily mean that the company has to have a small market cap or that the sector is composed generally of companies with a small market cap. What it means is that whatever types of risks small companies tend to face that investors want compensation for, the companies in this sector also face those risks, whether they be big or small. The same thing goes for the HML beta. Just because a sector has a high HML beta doesn't necessarily mean that the companies in the sector all have high book-to-market ratios. However, they will tend to face the same sorts of risks that those types of companies have. So let's interpret the results of this 3-factor model. What do these factor risk premium mean? Well, there's 2 interpretations that we can take. One is that these risk premia represent genuine concerns that investors are correct to be worried about. So if we think about small minus big, for example, well, think about small companies tend to face a lot of problems that big companies don't have to deal with. And this is something that, all else being equal, investors would prefer to invest in a bigger company because there's certain risks that small companies face that big companies don't. And so this is something that needs to be priced in. This is something that needs to pay some type of premium. Otherwise, people would not want to invest in small companies. Likewise, for the value versus growth, if we think about what a value stock is, a stock that's worth a lot on paper, but is not worth a lot comparatively on the open market. So this means that value stocks tend to be companies that, financials aside, tend to just be undesirable for some reason. And once again, this is something that reflects a legitimate concern that investors want compensation for. The other way to think about the 3-factor model is that the 3-factor model represents some type of mispricing, that the fact that these risk premia exist when they shouldn't exist means that people are not valuing these assets correctly. For example, the fact that you get a higher return for investing in small stocks over big stocks may just mean that people are unfairly overlooking small stocks. And the fact that you get an excess return for investing in value stocks over growth stocks just means that people, for example, maybe overvalue growth stocks because they're too distracted by shiny objects and they get fixated on these growth stocks that seem very exciting when the value stocks that are offering a higher return might actually be a better investment opportunity. So we have 2 ways of interpreting the results of the 3-factor model. Either these risk premia represent legitimate concerns that investors have that need to be priced in, or that the fact that these risk premia exist when they shouldn't exist means that investors are overlooking good investment opportunities for some reason. And so this all ties back into another idea that Eugene Fama was also famous for, and which we will touch on in a later lecture, which is the efficient markets hypothesis.